Welcome to this week's episode of our, actually, what is it? It's our webinar, it's our masterclass. That's a cool name. It's a nice way of calling it a masterclass.
Masterclass.
Lots
Free
of
masterclass.
free masterclass. A lot of people are concerned about what's happening out there in the mortgage world. A lot of people are concerned about, interest rates and fixing interest rates and all that sort of stuff. And I'm meant to be moving over a little bit. That means you have to move a bit, Rose. We've got two separate chairs here. Don't go off the screen too much, Rose. There we go. We're right. We're all good. Awesome. If you can hear us properly, everything's well. If you can just leave a little comment in the comment box to say that we're clear and everyone can hear us, that'd be fabulous. And we'll get into tonight's episode. For some reason, I'm not seeing any chats. Anyone going to leave me a comment? Hello?
Too early.
Can you hear us? Okay, we may not have comments or questions tonight, so that we may be missing the questions. Anyway, getting into it, this week we've got lots of cool things to talk about, which is all things finance. So today, for those of you that don't know, this is Rose Renouf, and I'll get her to introduce herself in a moment, but I've known Rose for it's a long time now.
Very long time.
Very long time, nearly 2 decades.
I think it's 2 decades, right?
Yeah, I'd say a little bit shy of it, maybe 18 years.
Yeah.
18 years or so. I was about 18.
You were 18 then. How old are you? You're
I'm 36, turning
okay.
37, so I'm
So
double half my life. I've known you for half my life,
Yes,
Rose.
that's it.
And a lot of people ask me constantly, how do you build a large portfolio? How do you do it today? I always say you need the right team around you. Rose has been there with me for nearly 20 years now, and been looking after all of our investors and their portfolios as well. So tonight I want to talk, I'll get Rose to talk a lot about most of this stuff, so I've got to sit back and let Rose talk a lot about a lot of things. But tonight's agenda is here. I will be coming in and talking about the interest rate forecast for the future. Rose isn't going to do that, but I will have stats, facts, figures, and all different things, which will be very different to what the media is out there putting in propaganda. Which
Can I just introduce Zinga first?
We'll introduce yourself, Zinga.
Yeah, Zinga. Yeah.
Okay, sure. Over to you, Rose.
Over to me. Hi, as Nathan has said, I have been a mortgage broker since probably 2002 from memory. So
it's almost 20 years.
Almost 20 years.
20 anniversary. Do you remember what date it was?
That's right, March 2002. So
it's over 20 years now.
Yes,
there we go. We should be celebrating that.
That's it. Yeah. So my background is I'm an accountant by trade. So I understand finance very well because obviously, numbers, financial statements, that sort of thing. Now I want to talk about Zinga Finance. Now I'm the head of Zinga Finance. We are a team of 12. So I have 4 brokers, 8 broker support. With our team, we work closely, broker and broker support, they work very closely. As you probably has experience with us, when the broker interview you, there's always that broker support that will communicate with you in terms of where are the documents and that sort of thing. The good thing about Zinga Finance, we're not a one-man band. So in the event that you can't get your mortgage broker because obviously probably she is sick or he is sick, so you can always get the broker support or myself. We know your file very well, so everyone has an idea of what's going on in certain files. Now tonight we'll be talking about mortgage finance for all walks of life. So I'm saying that we will be covering the PAYG, the casual employment, the self-employed, and how we gonna assess the loans and things that bank has changed a lot of their policies in terms of income verification for self-employed. That is big, that is huge, right? So can we get to the agenda?
Beautiful. Just on that note, Rose was, I felt like you were stalling a little bit there, Rose. I had someone else in the room here fixing up our question box, and there's a chat box up, not a question box, and now I've got everybody's questions that you can hear us.
Already?
Everyone can see us and hear us now, so yeah. Keep those questions coming in throughout the evening. So we just went past the agenda, but we'll go back to it if you want.
So tonight's agenda is we're talking about how much can you borrow, harvesting equity from your existing investment properties, how does loan portability work, and when is interest-only loans repayment is relevant, and also how to grow your investment property portfolio. Should you fix or should you not, right? And obviously Nathan will talk about interest rate forecast. Now,
won't I ever?
Now, how much can you borrow? When we talk about how much you can borrow, for example, we talk about the PAYG employees, right? A PAYG, your income is through you're working for another firm. Now, obviously, to verify your income, you need a pay slips, and it is mandatory nowadays. The bank needs to sign a year-to-date element of that pay slip. So some of you probably will experience that we always ask, can you provide a pay slip that has a year-to-date income? Coupled with that, you have to also provide a bank statement that verify that net income from your pay slip. Now, this will also minimize the bank calling your employer and verify your income because they can verify it through the bank statements and through your pay slips. Now, obviously, with the base income is basically assessed at 100%. And then when you have the bonus, it is assessed at 80%. You have to remember with bonus payments, you have to have a 2-year history.
Would that apply to commissions and
commission
overtime
is
and
different.
stuff?
So
okay.
With bonus, you have to have 2-year history, and it is also shaded to 80%. For the commission, it is also shaded at 80%, but you must earn those comms. You have a history of earning those commissions for the last 12 months. Overtime is assessed at 80%. Salary sacrifice, this is very common to those nurses, frontliners, and they normally have salary sacrifice that are, I think from memory, 19,000 a year tax-free. You can add that back, whatever, so because what the bank was looking as the taxable income, salary sacrifice is taken from the taxable income, so we can add back the salary sacrifice.
Okay.
Now, superannuation employee contribution, you need to look at, like, if it is a voluntary contribution, we can get a letter from your employee that says you can turn it off if you wish to. And then that requires a letter, right? Mm-hmm. Now, we can also talk about, now, that is for PAYG in a nutshell, but with the self-employed, now, say self-employed traditionally, we need to get a 2-year tax return.
Yeah.
2-year company tax, a 2-year financial statement, 2-year company tax, individual tax return for 2 years. Now, provided also with notice of assessment. Now, when it comes to self-employed, the bank now, CBA, ANZ, they have now called simple verification of income. So if you have been paying yourself, so you've issued a pay slips, right, through your company, the bank, CBA and ANZ will accept that. For CBA, they will accept the pay slips, provided you have been paying yourself for the last 6 months. So we look at the 6 months of the latest pay slips and a income statement from the ATO portal that you can gather, and also a salary credit towards your account. Now for ANZ, you only need 1-year pay slip. With CBA need also a letter from the accountant that says your company is trading profitably. That's all it needed, but ANZ doesn't need that. They only need a pay slip, 6 months income being verified through your bank statement, and also an ATO portal to confirm the year-to-date income. So that is very, very helpful for self-employed. Now, you probably hear debt to income ratio, right? DTI. Yeah. You know what DTI is? Basically the total debts, including the new loans that we're applying, over the gross income. If you reach a DTI of 7%, bank declines. Mm-hmm. So we maintain over, less than 6. Even if you can service it, if the DTI is around 7%, they shy away.
Okay.
So
Is there any way that you can push that up or to improve that debt to income ratio? Or
We have to find banks that don't consider DTI. There
Okay.
are lenders there that don't consider DTI.
I guess, like, going off topic a little bit, a little off track,
Yeah.
right? I see a lot of our investors that get stuck, or they might be people that are coming in and they're like, hey, I've got 5 properties, I can't get to 6th because I'm stuck, the bank won't lend to me, etc. Obviously, there will be, a lot of people, 9 out of 10 people go, that's it, I can't do anything. But then it's like, how do you push that, right? And I've seen creative ways of people, buying an asset that's going to increase their position, or someone might have a property existing that'll be very bad. We're just changing the lighting here, folks. But they might have an income which is much, there we go, brighter. The income that is much lower on the rental property, and they buy and replace that, which we'll get into tonight. I think you've got security swaps and different stuff like that where you can improve that income.
But there are so many ways. We have a lot of experience. I mean, just this week, for example, we get a call from a client and says they have another broker, and the broker said, oh, you can't service. And I said, yes, you can. So we're able to help that person only because the broker only went to the main lenders. And then it creates like there's, your rental income versus the value of the property. It's called the yield, right? When the yield, with NAB, I think they do only 7% yield, CBA 7% or 6 CBA 6%, ANZ 7%.
Yeah.
If your rental income is yielding 10%, the bank will just cap it at 6 or 7%. So what we do then, we go and find a lender that can take the whole rental income, and that could push the servicing. And not a lot of broker knows that.
And even just like the policy at the back end of the bank, like I was actually talking to one of the brokers the other day, to Max, and we had this long-term client, and they knew when they came to us about 5-6 years ago that the position was a bit screwed up. They had these properties that were not worth what they paid for them. That they bought all these bad things, but they couldn't offload them. And they have a trust which is all trapped inside of that. The trust, the banks weren't looking at it positively, and they've been stuck for a long time. And Max is currently working with a lender which will look at that and go, okay, if the trust is self-funding, then it's not an issue. So it's understanding, I guess, which bank to take, which investor to, and as to why you've taken there too. Which
I think what you're trying to tell is that if you have properties under the trust, now obviously if you are a director of the trust, you are a personal guarantor of that liability. So there is a lender called, say, ME Bank. They would say, if it's under the trust, we don't take it as your commitment. What we will do then is that we'll just get a letter from the accountant that says it's self-sufficient.
Correct.
And what that means, your exposure, and obviously the DTI is only limited to those debts that is under your personal names. So things like that, we're very well versed with each bank's policy, and also we know which bank that we have a lot of strategy in place in terms of if you're going to be a professional investor. So basically there's the servicing, the equity, how do we position the loan, when will we exit from that lender and come in again with a different lender. So there's a lot of things that we do behind the scene.
I could relate to maybe 4 investors in the last 2 months that have gone to a different broker that have got stuck, right? They could have got equity. Like, I believe they would have been able to pull out equity immediately, but they couldn't pull out the equity just due to the fact of how their broker had structured their loan, whether they've fixed their rate or whether it be cross-secured, but that, for example, they've gone to CBA, the CBA will give the loan because they structured in a way where they had a full valuation, that valuation stays on file. Sometimes if you were to go to, like, I don't know, one bank and then refinance it in 2 months' time, a broker wouldn't normally look at that because they'll lose their commission, and it becomes a.
I think from what I gather from some of the clients that we have, they were saying the broker that they approach first always doesn't really work with their objectives. They always say, why would you buy investment property, right? Just be happy with what you have, one or two properties. But if your goal is to have a financial freedom in, whatever year, it will not do it. So what we normally do is we always proposition it with the client and says, okay, you bought this property below market value. So if you don't mind, we'll put in the second tier lender, because obviously the valuation will come, 90% will come the same as the purchase price, right? So from that second tier lender, we pull them out, and maybe in 3 months time or 6 months time or 2 months time, we'll refinance that property to the second tier, to the first tier lender, right? Like the CBAs, the ANZ. And the good thing about them, when you refi them, they're doing the desktop val. Desktop val, you have more chances that your valuation is higher than the full val. So that's
sometimes in some instances. So sometimes it's better with a full val, sometimes with a desktop.
It's better full val if you have renovated a place or whatever. But
case by case.
Case by case. But in general, desktop vals are more, and no hassle as well. You don't have to book with the tenants, and Yeah. So basically, we will present it to you. And say, like, we have one example for Peter, for example. I said to him, why don't we lodge it with First Mac first, and the purchase price will be the valuation, and then 30 days later, 42 months later, we refinance it to CBA, and the desktop valuation we get 89,000 more.
So 89,000 more. We paid
240, 328.
240, 328.
That is an actual. He bought it on the 9th of February, revalued the 8th of April. Now, if we have gone to CBA at first and moved to First Mac, we wouldn't have not got that valuation.
How old's Pete?
Pete is 20 in July.
20. And he's on to his second property now?
He's on the second property.
We'll get him to like 4 by Christmas.
He's buying for the third one already.
He is, yeah?
He wanted to. He wants to.
Cool.
Yeah.
Awesome. And we'll get him to 4 by Christmas.
So also remember, Pete is a newcomer, like a new investor. He has no property. So what we did, he has limited deposit. So we did a 90% LVR. And for a 240, 90,000, he was only paying 4,000 LMI. So when we bring it to CBA, we still borrow 90%, still another 3,000. So he spent like 7,000 LMI from the first lender to the second lender. But again, he ends up with 76 or 74,000 to use as a deposit for the second purchase and for the third.
And then if you go to the news, you'll see all these articles saying people can't buy a house, people can't do this, people can't do that. And here we are, doing this stuff every day.
So we'll also talk about loan valuation ratio, right? So you probably hear about LVR. Now, it is also the bank also has a called postcode restriction. Some postcode they'll only lend up to 80% or 70%. So loan valuation ratio is basically the loan over the purchase price.
So if you're buying it for 200 grand, you've got an 80% LVR, you'd have a loan at 160 and a 40 grand deposit.
That's correct.
Cool.
Now,
we go on another slide, or are we too far ahead, or?
We go to the. So how does?
We've already gone past. You've been talking. I haven't been keeping up.
Loan
to valuation ratio.
I've done that. Yes.
The expenses.
Now, expenses, you probably heard about HEM, right? Now, expenses is basically a general living cost. Now, this is based on the banks, based it on the income. If you hire a high earner, obviously the expenses is higher, and it also based on the number of adults, number of children, and the postcode of place of residence. If you live in Hunters Hill, that means council rate is more expensive. Now, there's also part of the expenses is also investment expenses. Some lenders will take investment expenses, so that's worth noting. Where are you going to place this? If servicing is tied, where are you going to place this person? Because they're going to take expenses, right? And then we also have then on top of the HEM, there's expenses that is additional to it is the personal insurance like trauma insurance, and also like private health fund. That is on top of your on top of him. So if you are boarding or living with family, there's a notional rent of around 550 a month.
550 or 5,000?
No, 550 a month.
Okay.
On average, yeah.
Okay, cool. Awesome. And looking at everybody's favorite question is like, how would you get the discount? Like, I'm going to get a loan. How do I get a discount? What I find most concerning with most investors, right? We've got to look at most people and common traits, because you'll find like between your most successful applicants and your most unsuccessful applicants, there's common trends that make them successful or unsuccessful. And the same goes with being an investor or whatnot. And what I've found over the years is a lot of people will try and focus on being a someone will try and focus on being a looking for interest rates. But is your biggest thing trying to save 0.25%, or is it getting your next deal that's going to make you 89,000 like Peter's done? So yeah.
So interest, obviously, some people are very rate oriented or rate shopper. No, you have to give them a choice. Do you wish to continue your investment journey, or you're not going to buy because the interest for this particular lender is higher? So you have the choice, right? And just if you're an investor, put it this way, you probably be in interest only there for a year or two. Tendencies is you're going to refinance that loan, right? To harvest the equity. We could probably be moving that to a different lender. So the interest that we quoted you at first could probably be there for a year or two until you refinance it. Unless, of course, you don't want to do anything, then yeah, fair enough. Like the interest may bother you. But the loan interest, we also have this thing called pricing discount. So the bigger you loan, the more discount you get. Let's say, for example, let's look at standard variable is always the base interest rate, right? So standard variable rate is say 5.39, yeah? If you have a loan of say 500,000, we'll say to the bank, hey, this is under a package, we want you to give us a discount. So if they give you a discount of 2%, you end up with a 3.39 interest rate. So we always make sure we go for pricing approval. We can't just say like, okay, hey, this is the interest that they gave us, let's just take it. We negotiate on your behalf. And then when we have, the good thing about having the pricing approval is that it has an impact in your servicing. Let's look at like 5.39 as a standard variable, and then you get a 2% interest discount. So you get an effective rate of 3.39. So if you have a 3.39, remember there's a buffer of 3%, yeah? So your assessment rate becomes 6.39. Now, if you're just gonna take, like if you didn't have the 2% discount, if you have 1.5 only discount, that means your assessment rate is
a 0.5% higher.
0.5% high, then the servicing can be an issue.
Yeah.
Yeah, okay. So it's very important to get that pricing approval, and we always negotiate for you, only because we want to make sure it services and also a better rate for you.
Got a question here, got a couple of questions. So I might just jump to the questions. Keep the questions coming throughout the night. We'll answer them as we go through. Anthony asked, when assessing servicing, I tend to get a no because single PAYG and 4 dependents. Is there anything I can do? I want to get a finance health check. Can you help? Yes, you can help and give a health check, but we don't know if we can help because there's lots of missing parts in there. So
4 kids, single earning, I don't know.
Anything, how long is a piece of string? So Anthony, you could book in a finance sort of health check with Rose. How would you do? How would someone do that? There's probably an email at the end. Is there an email?
Yeah, you can email.
What's the email address?
Zinger Support.
Zinger Support at.
Or Rose at Zinger Finance.
Rose at zingerfinance.com.au. Rose at zingerfinance.com.au. That's the easiest one. So
and when you send an email, if you're asking like how much can I borrow, can you also send us in that email your income as well as your commitments? Yeah.
Luke asked, how do the banks view annual staff bonus payments for borrowing capacity? Rose just covered that beforehand and said that they'll take 80%.
It's shaded to 80%, and you have to make. We need to have 2-year history when it comes to bonus.
So if someone got a bonus of 10 grand this year and 20 grand last year,
they will average the two.
So 15 grand, 80% of that. So
yes.
you get 12 grand.
Yeah.
12 grand bonus would go. Okay.
Yeah.
Cool. Matt asked, hi Rose, would love to, if you could share the DTI and borrowing capacity calculator that you use. I guess that's different with every bank, right?
It's different from every bank.
Yeah.
I can't. It's difficult to share the calculator because you will not.
The bank spits it out. The bank spits out the results, so you've got to input it in. And
but it's just like the total loan, the total debt over the total income. The gross income. So if you have a debt of 500,000 and your income is 100,000, so 500 over 100, what would the result? If it is less than 7, it's fine. If it's over 7, then we'll have a problem.
But then if you have income from rentals of 100 grand a year, they'll take 80% of that.
Yeah.
So it'll be 180.
All the taxable income.
Yeah. Yeah. So it's very important to get the property strategy right as well as the debt.
Yeah.
Kyle said here, do you still advise never cross collateralize property, or is it okay in some instances, for example, grouping all the properties owned in one trust under one loan? Rose can answer that, but I'll answer as well. Fuck no, never. Would we do it? I think maybe in the history of Zinger Finance, we might have 0.01% of loans that would be cross collateralized, like 0.01, and that might be because someone's restructured a debt or.
I think there was one instant that it was necessary for me to do the cross securitization. What I did is that servicing was an issue, right? But I want to maximize that equity. So I go with ANZ and I said, they're going to buy these 2 properties unencumbered. The bank said, how are we going to control the properties they're buying, right? We're taking into consideration the rental. So what I did, I cross-secured that to the property. And then when the loan settled, I applied for security variation. I took it out.
Yeah.
So that was the only time I cross-secured, but I removed that after the settlement, probably like 2 months later. And now the loan is
There's 3 reasons. There's 3 reasons why your broker would be doing that. One, they're lazy and they want to do 1 loan application instead of 5 loan applications, for example. They're dumb because then they just don't know. Or the third one is that they're trying to trap you there so you can't refinance and move your position. Like our mate the other day, without going into his name, I'll draw his name here just to give you a bit of a refresher. That person. Someone, they went to a broker and all their properties got crossed together. They completely screwed. It had so many options. They're stuck now. They crossed them and fixed them at the same. So they're stuck for 2 years unless they want to pay massive break fees and all that.
I think most brokers, what they do, they cross-secured, because I asked, why was it cross-secured? So what they were doing, they get a home loan, right? They get a property and they're buying an investment. They want to use the equity on that home to purchase the investments. So what they did, instead of creating a standalone of the home loan into 2 splits, like 1 home loan and the second split is for investment purposes with a limited right to use that as a source of funds for the second purchase.
So what Rose is saying, let's use an example, like someone buys for has $1 million property and they've got a 500 grand loan. What Rose would do would have a 500 grand loan, leave that there, but have a second mortgage of maybe 100,000 or 200,000, and with that money you can then use that as a deposit
for the investment
properties. So it's all standalone, and so the risk is minimized too.
So what other brokers do, they just lump like, okay, we'll just cross-secure because anyway, they're all your loans anyway. That's what I was told. Apparently he was told by the broker, don't worry, they're all your loans, it's the same exposure, but they don't realize that there comes a time when you want to refinance this property as increase in value or sell, then
take a profit.
You end up with a problem of, you know.
I was on the phone to someone very close to us recently, and he didn't realize that some of his loans from many years ago, not through us, that were just written, were crossed, and he went to sell a property, and then when it came to settlement date, they said, well, what are you going to do? You're going to reapply, or you're going to pay out the other properties attached to it? And they're like, what do you mean? And then they found out that there was all these other properties attached. Fortunate enough, I was able to guide this person to be able to then get the property revalued and then keep all the funds of proceeds, right? It was a very rare event that was like got the person out of jail sort of thing, but 9 out of 10 times, 9.5 out of 10 times, people that do it are screwed and their hands are tied behind their backs. And we'll keep the questions coming. We'll get to more questions, so I don't want to go too far off. Right?
Harvesting equity, this one, I love this one.
So we've talked about trust?
Trust, okay. Guys, properties under trust, they don't have any negative gearing benefits. Tax benefits, yeah.
A lot of people go, oh, I'm going to buy under a trust, it's better. If you're buying a property in Sydney, yourself and your spouse have probably got about $800,000 each worth of non-tax deductible, like non-land tax purchases. But if you buy under a trust, you're paying land tax from day one. So land tax is 1.6%. If you've got $1.6 million worth of property split over between two people, that would mean that you'd be saving 20 grand a year. If you put that same $1.6 million worth of property land content under a trust, you'd be paying an extra 20 grand a year. If there was some negative gearing to that, or any sort of tax deductions, could be modern property, could have depreciation, could be whatever, you are missing out because those losses are now trapped within inside of your trust, and you don't get any access to them. Does it affect your servicing when you have that? It
affects servicing, yes.
Because you can't do the add back of the.
You don't have the
add backs. It's an expense, but it's locked in.
But you're lucky, so it's. But then again, you get ME Bank too that can do it.
That's what happened with the person, right? I'm going to write a little note that for you to go into that as well with that client. But their position, their tax benefits were stuck in that, which meant that they couldn't service. If their properties were out of the trust, they would have been able to, but the problem is that those properties that they bought, even though they bought them 10 years ago before they met us, they were still worth less because they were dud properties from spruikers. So buyer beware. Talking about probably one of the most important sort of topics of this evening. Everyone is sitting here going, okay, Rose, you're the magician. How do you get the equity out of my properties? How do you do things differently to the other brokers out there, right? Like I've been told from my broker, I might have to wait 2 years before I can get equity. I've been told I have to wait 12 months to get equity. How do you get equity to start off with? What is the equity? And, what's the best ways of getting it? So, yeah.
Okay, let's look at normally I often get asked, how long before I can get my property valued, right? Because I want to harvest equity. Now, if the property, when we first launched that application, if it was fully valued, like full valuation, that will 6 months before you can even get revalued of the same lender, only because full valuation, they have a record of that full val. They would say it's still the same valuation 6 months ago. Now,
and it's a policy to have it attached to the file, so that
they can glance, right? And then you have also the desktop valuation. Sometimes we go like 45 days or 30 days. Now, if the property was desktop eval, the way we do it, right? If, as I said to you previously, like if it is a purchase, if it's okay for this person, I would say, okay, this is a purchase. Now, what about if we'll just launch it with the second tier first, right? If you really want to harvest the equity. So I'll start with PEPA, first MAC, second tier, right? And then maybe the same with the example that I had with Peter. And then 30 days later or 40 days later, I said, hey, we keep track on your property, right? What would be the, would-be valuation if, So we look at then, with your permission, we'll send an email to you, or you request to us and say, can you revalue your property? Then we'll go to the main lenders and they can be valued 30 days later. It could be up in valuation, right?
So I guess that's where when I'm finding properties for our investors and we're building the portfolios, a lot of people go out there and try and do it on their own. They go and try and find their properties, all that sort of stuff. I'm buying the properties sort of below market value that have got equity, got good cash flow, and I'm understanding. And whenever I buy a property for someone, I'm always thinking about, okay, what do they need next? Do they need equity for the next deposit? Do they need cash flow for servicing? How can I help you boost their servicing up so they can buy more property, buy the asset that they're choosing? And quite often, like I'd say about 80% of the time, I walk around the office, not just with my rat's tail, but I'm like a debt collector saying, guys, I've got all these investors that I've got here, give me some equity, right? Literally, right? It's the thing. Everyone, when they see me walk around their office, they're all like, oh shit, Nathan's going to come to me and want equity up for people. And I'm constantly walking around with like, Zinger might come to me and say, one of the team might say, hey, we've got 50 grand equity or 100 grand equity. They're excited because the client can pull out 80 grand of the equity. But as soon as I get a glimmer of that, I'm constantly back on and going, who else bought in that street, in that suburb, has a property like that we can go back and extract the equity from? And, being proactive, most brokers out there are like, oh shit, we've got to do another loan for $30,000 or $40,000. But we're looking at it from a different approach and making sure
I think also like, because as I said, we're a team of 12, we're like on the phone all the time, doing evaluation, and then someone would say, hey, I just valued Harris Park, or I just valued Woodridge, or this particular bird, it went up to 60,000 or 80,000 more, then we will send you an email. Hey, do you want your property valued? We just valued one of the properties around the area is valued this much. Do you want to try, So that is the advantage of having us, because we write like 120 loans a month, right, or more, and we constantly know where the valuation is and how much they're valued, and we keep note. We have a copy or a property list for each file, and we say, hang on a second, so and so has this property. Let's check it out, or ask the client if he wants it revalued.
I've got 2 specific unit complexes on my screen open at the moment. There's about 20 people in each one of those sort of files, and I'm going to be coming to Zinger in the next 24 hours to say, hey, let's go and get some equity for all these people. So
we do monitor your properties, right, in terms of what would be the valuation in the next month or two. So we always have a note. I said, keep track on this property. I think this one will be,
Yeah.
So we're not just brokers. We'd like to hold your hands in, wherever you travel in your investment journey, we will be there for you.
Just a shout out to any of you that are watching. I can see some of your names in here and people that we've helped out over the years. If we've bought you anything in Brisbane, in anywhere around Brisbane, anywhere around the Gold Coast, specifically around the Gold Coast, I remember buying properties for people in Tweed Heads, right, for 155 grand for a 10-year-old unit, 2-bedroom unit. Now they're selling for like 400, 450 last time I looked at them, and they've gone up higher. Other areas in south of the Gold Coast were bought for 180, and now they're revaluing at 600, 650. So there's a lot of people out there that don't realize the equity that they're sitting on. Like all of the ones that Zinger have written the loans for have been in contact, but if you have and you haven't used Zinger, make sure that you do reach out and see if we can get that equity up for
we have one that came last week, and he says, oh, my broker said they couldn't help. We really like to buy this security, but there is like a limited title. You know what a limited title, right?
Different titles, yeah.
You can't define the border and that sort of thing, right? Limited title. And he says, I really want to buy this property because they believed it will increase in value. And then the broker said, no, no one will touch it. We're able to do it. Well, just like we do a lot of workshop with lenders, and if you work hard, you'll find a way to get this done.
I know, Rose. I know first-handedly the lengths that you go to find those lenders. The other thing, so I could see a lot of questions coming through. I'm just going to rattle off a couple of questions and answer them very quickly, so we're not congested here. Matt asked, hypothetical question: how does one protect an investment property purchased when singled and continue to be held in single name when eventually married from a divorce later? Would a trust work for the outset? No. Not particularly. I've seen people with trusts get sued. One way you can try and protect yourself is a thing called a bloodline trust, which can go up, down, out to your children, out to your siblings, but can't go to someone that's not in your bloodline. However, once again, you do come across other issues of being able to purchase, and the financing becomes more difficult. Other ways are, you know, a lot of my properties have loans to other people. You know, most importantly, don't go get sued, but make sure you find a, you know, someone that's going to be a good partner if you're looking at it from that perspective. But also, there's other ways that you can sort of protect yourself along the way, which are more probably legal questions and, you know, accountancy questions rather than the financing question. Adrian asks, can we request which type of valuation we get, or is it always up to the lender? I know the answer. We wish.
Yeah.
We wish we could tell, but unfortunately, it's up to the lender as to who they choose to go out there and value the property, and which sort of valuation type they want to choose as well. If not using a trust, what do you recommend? Personal names. Personal names or trusts are the main structures. I don't buy anything personally in companies or anything like that. I buy them in company structured trusts. So the trust is the structure, or your personal name, or you can have your corporate trustee, or a super fund. So super funds, trusts with a corporate trustee, or a personal name. And yeah, let's move on to the next one. So full valuations. Then we've got second tier lenders. What is the difference between a first tier lender and a second tier lender?
Oh my God, I love the second tier lender. You know, they are investors. They should be your best friend.
Yeah.
When servicing is an issue. Okay, let's look at the second tier lender. With the bank, when they assess the loan, they'll assess with the assessment rate, right?
Mm-hmm.
Even if the loans that are not going to be refinanced or existing loan, they will assess it as per their assessment rate.
Yeah.
So, you know, whereas with the second tier, so I like this application, 300,000, they'll only assess that particular 300,000 loan as per the assessment rate.
Yeah.
The loans that we're not touching, they will only use the actual repayments of those loans. See the difference? So servicing, you could be like 500,000 more that you are able to service. No? So that is one of the lenders.
Someone just texted me.
Yeah.
Don't say the name, but you see the person's name. They might be watching. One of our really good clients have got to 13 properties at the moment. We're about to try and pull out some equity. I need to talk to you about that person to pull out equity. So we'll just put a little note here. Yep, for next steps. This person here, I've been talking to about making sure that we get the right lenders all the way through. So I want to go back to CBA for this person, pull out the equity, and then once we get that equity, we take that equity to a second tier lender, and we go and buy another half dozen properties to the second tier lender. Because
in all honesty, the second tier lender has very good interest rate.
But the equity and the ability to pull out.
Ability to pull out. That's all. You put them when there's a purchase. As I said in the beginning, like when it's a purchase, go to the second tier, right? But even like, you know, like if servicing is an issue, you look at like one of the lenders, First Mac, for example, the rate is 3.04. Not bad, hey? Interest only investment. And yet when they assess the loan, they do the assessment rate as well for existing loans, but the negative gearing is based on the assessment rate, not on the actual rate. So again, that is tax beneficial to the customer in terms of servicing, and servicing can be, my goodness me, it didn't service with big lenders, it serviced comfortably with these lenders.
Second tier lenders, the benefits of them is, I'll call them a shit bank, that's my term. So when I speak to our investors, I'm like, oh, we'll go to the shit bank for the next one. But the second tier lender, Rose goes, no, they're not a shit bank, Nathan. They're very good banks and they give very good loans. They are the best bank and the easiest bank to be able to get loans from.
And fast. Good rate.
Easy to get a loan.
The only one.
Decent roads, but some of the rates are higher and some of the products are a bit different.
It's just the upfront cost, because you have to pay for the valuation fee, which is 330.
But then we also have to look at the other aspects of it, which is the pulling out the equity component, right? The pulling out equity, you may be stuck there for 12 months and they may only do a full valuation, not a desktop valuation. And if the value is bad, then that valuation stays on your file for 6 months or 12 months. So there is pros and cons at different stages of your portfolio. You know, these different products will be advised from Rose and from the team, and that's the importance of having a good debt strategy as to when do we go into which bank and when do we get out of that bank and when do we go to the next one.
I don't think you guys realize that when the loan is a bit difficult, there are 4 brokers that contribute to how we're going to do this, right? What approach have you experienced this and sort of thing? So we have some brokers to
bounce the
ideas off.
Yeah.
And we kind of, because we get a lot of lenders that come over to the office and give us a workshop, and we kind of well versed in their policies, and we even know which postcode is not acceptable to that lender, which postcode that the lender only assess the rental income by this much. So so it is very helpful when you have a deal that is a bit curly.
Yeah,
we do it all the time.
I've got a couple of questions here, but this one here is just for you. Don't read it out. From Pete. That's a question there, just about an update on something. Jimmy says, "What's up, Nathan? Good to hear from you, Jimmy. Hope you're doing well. It's been ages." Kyle just asked a very interesting question. That's the question I want to ask: is do you own in all different structures? Example, some of them in trust, some of them PTY, some of them personal name, some of them super. Do you only have one property owned by one structure? For me personally, I've got 50 different structures with properties in. Some are purely just for motels, some are purely for properties that own cash outright, some are owned for shopping centres that are all just commercial stuff, so the GST stuff. It depends. It's important to have a strategy on that front. So that's probably more of a deeper question, but how do you structure yourself up? It's important that the finance is in line with that. A lot of people don't realize, and this is going back to those trust structures, because a lot of people ask about trust tonight, Rose. When when you go and purchase property in a trust, is it the same as buying under your personal name, or do they then send your file and treat your property more of a commercial loan?
No, it's the same as a personal name. The only thing that is different there is how the negative gearing.
Yeah. So they put the commercial, do they not have the commercial team that overview it, or
no? No,
okay.
It's not. It's
okay.
not. Yeah.
Okay.
If it's a residential security,
yeah.
The only time it become a residential security and commercial in nature when there are multiple dwellings.
What I mean is, do they, let's say that at the back end of the bank, when they assess the file, do they look at more of a commercial, like it's a PTY LTD?
No,
Okay.
It's not.
Okay.
It's really.
Okay, cool. This one here, you can go on and talk about this for ages. I've got lots of answers for people on this. A lot of time people come to us and they say, "Hey Nathan, I can't get a loan. What do I do? How do I get from 3 properties that I'm stuck at to get to 10? I'm thinking of selling a property, getting rid of this one that's a dog," whatever the case may be. A lot of people don't realize that you can actually make a loan portable. So that person that we're talking about with the 13 properties that you need to get back to, she just sold a property that she had and replaced it. I think it was getting about $600 a week or something like that. And with a 600 grand purchase, we ended up getting about $1,500 a week rent from 3 new properties that we replaced it with. So her income has gone up $1,000 a week, 50 grand a year, which is going to positively affect her position so she can come back and service some more properties. How would one go about making their loan portable, and what happens there, Rose?
See, portability, obviously you are replacing the security, right? Mm-hmm. The loan account remain the same. The loan account, the loan balance must remain the same. So if that is an 80% LVR when the loan was first lodged, you have to replace that with a security that can verify the LVR at 80%. Mm-hmm. There is also a simultaneous settlement, right? Different lenders has different way of doing. When you sell this property, the incoming purchase must settle at the same time. Now, for the purchases to be verified as acceptable securities, then you need to get the bank to let them know that this is the securities that would replace the outgoing property. Mm-hmm. They're going to revalue it, everything. Sometimes they randomly look at your servicing if you have been delinquent in your repayments on that loan account, right? Mm-hmm. Now, let's look at the way they do the portability. It doesn't have to be simultaneous settlement, right? Yeah. You can sell this property, this purchase can settle later. However, they cannot let go of the property without having a saving. You have to have a savings account to secure this remaining, the loans.
So there's two different ways that this can be done. So you can do it as a security swap, or you can have a portable loan. So there's two different products that are out there. If your loan is with a deposit taking institution, then you can make your loan portable, because what they do is, instead of having the house, let's say that you've got $1 million property and a 500 grand loan. If you sell it, you put 500 grand in your pocket, and then you've got the 500 grand you pay out your loan, and then the money goes back to money heaven before it was created. If you have if you make a loan portable, then you can go to CBA, St. George, Westpac, whoever, and say, hey, I'm going to sell a property and buy another one. What I want to do is make my loan portable. What they can do is set you up with a thing which is instead of like a term deposit.
Term deposit, yeah.
So because it's a deposit-taking institution, you can sell the property for $1 million, take 500, keep the loan at 500, and put the proceeds of the money into that fixed term deposit. And then when you go and purchase another property or multiple properties, then you can then release that money, and then the bank takes hold of that new property. That would be one of the only times, like, aside from that, that'd be the only time that it would go cross-collateralized, or 1 out of 1,000 times of that you'd think about cross-collateralizing, which would be like what Rose spoke about beforehand. But a very, very important thing. I've never seen any broker out there talking about it.
It's very complex to manage.
We were talking about videos to make beforehand and content ideas, right? We're going offline to a little personal conversation here. These are the sort of things that we should be doing in the videos.
See, the loan portability is in a way helpful, because you don't have to be reassessed in terms of, say, for example, you lost a job, right? And you just want to stop the security. Some banks they don't need to assess you with servicing, so it can be helpful.
Beautiful. I think
so that's portability.
Simultaneous settlements that we need to have. Yep. When is interest-only loans relevant? And obviously, we can't talk about, should you make it interest-only, or shouldn't you make it interest-only? Everybody's position is different, and we should do a little disclaimer at the start. None of this is financial advice. If any of the financial regulators are watching, they can get stuffed, because we're not saying anything that is constituting as investment advice. We're just giving general advice today. So, what is the reasoning of having interest only? Is there a benefit of having interest only? When does interest only or principal interest play an effect? Does it affect your servicing any different, Rose?
Yes, it will affect. So let's look at interest only, right? Interest only, I got asked, there was one client that asked me this early this week, right? Apparently he has another broker. He just wants to check with me if his broker is doing the right thing.
Yeah.
And I go, if you can't trust your broker, why you ask me? I mean, you should be asking these questions to your broker. So the interest only is mostly, I do not write interest only for a home loan. I always have it's a principal and interest. Now, interest only, basically we use it for investment purposes, right? The reason being, if you want to be in interest only repayment, is to maximize tax benefits, to maximize also cash flow. Yeah. So those are the two main reasons. Now, investment, sometimes if you're paying interest only, and I'm going for your servicing is a problem, I'm going to a second tier. As I said previously, second tier, sometimes they will assess the loan, those loans that you're not refinancing, or those loans that they're not touching, they take the actual repayments.
Yeah.
Interest only, obviously repayment is lower compared to P&I. Sometimes that's beneficial, but interest only repayment also, there is the bad side. The thing with it is that when you do the servicing, the bank would set it at 30 years term, right?
Yeah.
If you have an interest only 5 years, that means you're only left with 25 years amortization for the whole capital. So that is the downside of having interest only. So what we do then, because the tendency for investors, they don't leave the loan there for a long time anyway, they tend to harvest equity. So we'll reduce the interest only portion by 2 years. But interest only repayments is basically, main reason is to maximize tax benefits and also maximize cash flow.
On your cash flow, if you're paying $50 a week off a property, as a principal, it's really going to make no difference. $50 a week over a year is 2,500. 10 years, it's 25 grand. You're not really paying much off. Most importantly, if you've got 10 properties and that's 25 grand a year, that could be your next deposit that you're paying back to the bank earlier. If you pay the principal off, then you're going to go back to the bank and beg them to give you your own money back. It would be kind of stupid paying a principal down in the early phase of your portfolio. Josh, you've asked a question, and I think I'll be answering it with this, and Rose will be covering it here. Like, interest only, for me personally, I've had my loans as interest only when I first bought them, and I've let them turn to principal and interest over the years. So now, like, the rents have gone up $50 over 5 years, or $80 over 5 years, $10 this year, $20 next year. Now that they've turned principal interest, the positive cash flow that's been generated from those properties is helping to pay down that debt. I don't really care about paying down the debt. I think it's the silliest thing ever, personally. When, if you're an owner of a property and you've got a loan attached to it, and you're paying off your loan at 3% interest, you're just saying that you can't get a better return than 3%. Anything you buy, inflation is greater than 3%. So the interest rate is way below inflation. So it's really a bad choice to pay down your loan, because whatever you go and buy with cash is going to buy you less of it next year.
Yeah, that's right. Yeah.
Any other comments on?
No.
Okay. Maximize tax, maximize cash. On to the next slide. How to grow your investment portfolio, Rose. Got a few scenarios.
The scenario, new investor with limited deposit, that's, like we talked about Peter when he's a newbie.
Yeah.
And limited deposits. So we do 90% LVR. We put them in the second tier lender, then refinance 2 months later to the first year, and then prime lenders, and obviously desktop valuation came higher than the purchase price. So that's one in terms of how we grow your portfolio, is knowing where we're going to lodge it first, and knowing which lender has a better valuation around this area. Knowing also, like, in this particular lender, we don't go there because they always ask for full val. So that sort of thing is, we are well versed in. We basically know which lender we could put the loan, or how we gonna get this valuation done. So basically, we revalue your property, hoping if you have around 50,000 equity, then we refinance that loan, and then maybe if servicing is a problem there, we'll wait, like, let's say, okay, the refinance reason is to purchase investment property in the future, which is correct, right? And then when that's settled, and then we'll look at again how you best can service the loan, then we'll lodge the application maybe later. And
we've got a scenario now at the moment. This is something different to this slide, but I was talking to one of our investors today, and they're buying 5 properties at the moment. 5, right? And we've refinanced their existing property. They thought they couldn't even get 1, but we got them 5, and they're a bit scared because they bought it, they're cool, and they're in the clauses. They've got their 21 days, their finance clauses and all that, and we can only get 3 loans with 1 bank, right?
Yeah.
So the bank wouldn't service for anymore. So we purchased the properties, and we've got to wait until they have to go and that loan settles, and they purchase it, and then they're positioned and they can take it somewhere else. So then, there's a delay. Sometimes you might have to wait. Like, even though you could buy 5 properties or 10 properties, sometimes it's better to only buy 2 properties and then, restructure it, like go get your refinance, or, this person, I think, is buying one of the properties cash. So they're buying, like, they're using the equity, buying the property cash, and then,
Yeah, we do that all the time. Say, for example, we revalue this property, there's enough, like there's 200,000 equity there. And yet when we do the loan with this particular lender, they could not service the loan. So we'll just buy, the purpose for 200,000 is to buy cash, right? Property in cash. And then once that's settled, well, then the unencumbered property,
you can take it to another lender.
Take it to another lender and put some loans in it.
Yeah.
But I think, you know what, not to boast or think, a lot of brokers there are lazy.
Yeah.
They really don't care. They don't entertain if you only have 50,000 equity or 30,000 equity. For them, like, why would you do that?
But I don't know if it's
stop buying investment, just get on with life and be happy with what you got. And they've always been told, and a lot of our clients say, oh, I got this broker and it just doesn't in sync with my goals.
Yeah.
So you need a broker that understands your situation, you understand your goals, and you know, be upfront with, you know, how they're gonna structure their loans. And you know, there are sometimes like if servicing is an issue, we've always like coach them like maybe in 6 months time you'll be able to service the loan. If you can pay this off, you can pay off this debt. And sometimes we go to the extent like if there's a lot of equity and servicing is an issue, we will say, why don't we just pay off the HEX? Or why don't we just pay off the car loan? That will help you servicing.
Yeah. And if we look at like a scenario, like you've got a few scenarios here, Rose, like of owning a home, how could, like some people might be sitting here thinking, okay, I've got no money, I want to start buying a property. Like the previous one was, you know, if you're just starting out and you've got a little deposit, but then you got, you know, what happens if you don't have a deposit, like, and you've got a home that you own, like how could you get the equity out? Like what would be the scenario there?
If you just have a house and you want to buy an investment property, so your source of funds for the deposit or to complete the new purchase comes from your home. So what we do then is either we stay with the lender or refinance. So we structure the loan as, say, for example, you have 800,000 valuation in your house. You only have a 350 or 250,000 loan on that house. So 800,000, potentially you can borrow 640,000, right? We might not need the whole 640,000. So we will structure your loan like, okay, PPR, this is the structure of the loan. The first split is a home loan of 250,000. The second split is probably the 200,000 to be used for the purchase of an investment. So that is the first transaction, a split loans over your PPR. The second thing, a separate loans, then we'll do the investment loan. So in that way, your PPR, your loan are not cross secured. And for tax purposes as well, you're able to determine which part of this home in your property that is for investment and for the home loan. So it's easy for tax purposes as well because you get two separate statements. Some broker days, as I said previously, they just like, oh, okay, we'll just secure the new investment and your home, right? They're all together, the same exposure of liability, but administration-wise, past settlement will be an issue.
Yeah. Next scenario, getting the equity out of existing properties, Rose?
Yeah, it's the same scenario, even with investment and yeah.
Yeah, so you just be pulling it out of investment and you're not living in that. Okay, cool. What about tight, like let's say for instance someone's stuck with the servicing, right? They might be sitting here saying, hey, I can't get a loan, you know, I got rejected. This is
where the second tier comes in.
Yeah.
And we have 3 second tier or 4 second tier lenders there that are really good rate. The only thing that you would not like with them is because of the valuation fee, which is 330, right?
Yeah.
However, if servicing is an issue, they are your miracle worker, those second tier lenders.
Yeah. And
they have a very good rate. I mean, 3.04, 3.29, they're even better than the main lenders.
Yeah, that's good. So that's one option. The other option is to naturally increase your servicing. One is to work harder, or you know, another way is to make your portfolio work harder, and that's the importance of making sure that your cash flow is strong. You've got, you know, the right cash flow coming through from your properties. You've got the right you know, the rents coming through. I see people's properties when we're buying them. Rose, you see this every day of the week when people are buying the properties, like their rents are sort of, you know, they may be terrible. Their rents might be really crap that they're buying, and they could put the rent up $50, $100 just from buying it. So there would be so many people out there that are selling their properties or whatever the case may be because their portfolio isn't optimized to get them. The lending and to
so this one with tight servicing as well, you know, we have to find a lender that doesn't cap the yield.
Yeah. So what do you mean by that, capping the yield?
So for example, CBA, the yield is capped at 6, right? I think 6, NAB is 7%, I think ANZ is 7%. So if your rental yield is 10%, you're wasting the 3% because you don't take it into account in servicing.
Yeah. A big question, right?
Should you fix or should you not, right?
Correct, right? I sent you someone's details on the phone just beforehand that we were talking about when we had some dinner beforehand.
Yeah.
And that person had that question. He asked me all the questions on it afterwards, and that's what his query is. Should you fix? I felt like saying, apart from he lives in a different country at the moment, to come watch the webinar tonight. But should you fix the interest rates or not? And this is something that Rose doesn't like to, give advice on or give commentary on.
Can I put like a blanket
Disclaimer, like none of this is like.
Yeah. No, when you fix, you always have to measure your tolerance to risk, right? When I say tolerance to risk, if the interest goes up, can I service the loan or not? If the interest doesn't go up, I'll just stay with this fixed rate. If the interest goes down, would it be hard done? I will not be bothered, because at the end of the day, I measure myself that I can service this particular interest rate. So tolerance of risk, you need to identify, you need to be able to see if you can or not. Now, I think the interest rate for fixed now are already a lot higher.
They've been beefed up already.
They're already been higher. So if you look at it, what I have here, for example, based on a 450,000 loan, right? Now, full doc, interest only repayments, and this is variable.
Is this from like a big four bank, is it? Or?
Yeah, I based it in a 4 bank.
Okay.
So for 450,000 loan, variable rate is 3.05, right? 3.05. Now, if you're let's look at the 3-year fixed rate. The 3-year fixed rate at the moment is 4.69. The difference between 3.05 and 4.69 is basically 1.85%. How long will it take you to get to 4.69?
And the other thing,
2 years?
Yeah.
It's not going to increase every month, right?
Or if it did, it would be fun because everyone would go broke. I believe that, and this is something we're going to talk about later with the interest rates, like you need to question, is it physically possible for the rates to go to these levels, and is it worthwhile doing so? Someone asked beforehand, am I fixing my rates? Have I got any rates fixed? I have 0 property interest rates fixed at this point. So none of my loans are on fixed rates. So the other thing that just from memory, sorry to cut you off, Rose. One thing I've got from memory is like, let's say for instance, someone's on 3.05, right? And the standard variable rate is 5.05 and they've got that 2% discount at the moment, right? If they go to fixed interest rate for the next 3 years at 4.69, what happens to their interest rate when it goes from, when it
past the fixed rate?
Past the, after the fixed rate. Does it go back to the 3.05 or does it go to the 5.05?
So this is also, you need to look at, there is one called revert rate. Revert rate is that on the onset, we negotiate for your discount. I say, I get a discount of 2%. Now, if I'm going to go fixed rate, I need to make sure I get the 2% discount after the fixed rate. Not all lenders would do that. Only ANZ Bank can say, okay, when you pass to the fixed rate period, you can get the 2%. If you don't have that, that means you start negotiating again for the discount rate, right? The discount rate, today, or this current climate, banks are so generous with the discount rate, right? Can you believe if you get a 2.1 discount for the life of the loan, for example, that is a pretty good discount, right? And if you have a fixed rate of 3 years and you do not secure the discount rate past the 3-year fix, you go to a standard variable rate. So you're going to end up again negotiating for the, lucky if you can get 2%. They're only giving 2% at the moment, but from memory, when I first started become a mortgage broker, it was only 7.7, 0.8.
So if you have an old loan and you haven't refinanced it in the last 2-3 years, you need to come and see Rose to see if you can get that discount increased.
Yes. So if you're concerned of the fixed rate that is of your rate, and you don't want to fix it, please see us, because we may be able to review your loan and see if we can get a better discount rate. Now, discount is really based on the standard variable rate and the discount that we're negotiating with the bank.
Any other benefits of having a fixed rate? You're betting against the bank.
The fixed rate, the only benefit there is certainty, right? You'll be certain how much you're going to be paying for the next 3 years or 2 years or whatever. But if you look at I think if you have fixed it probably a year ago, maybe. But now it's like as I said, for a 3-year fix versus a variable rate, you're looking at a 1.85% difference. That will take 2 years, I think, in my opinion, to get to the 4.69. You reckon?
I reckon.
So 1.85 divided by 0.25. If the increase is every 3 months, it's not going to be increasing every month.
I think they're going to go up very quickly, and I think they're going to come down very quickly, just as quick. I'm going to get into. I've got some projections for people, and I did a bit of a live on it last night, and I'll go into further details. We're almost at that point of this evening. So, what other problems are there, like when it comes to, sort of fixing an interest rate, like equity release?
The problem with fixing the interest rate is that when you're obviously stuck with that, right? Because if you don't continue, if you cannot complete the whole fixed term, you'll get a penalty. Yeah. So it's not all bad thing, because if we have to stay with that bank because you don't want to pay penalty, we are limited to how much that bank can give you. We're limited to how much equity that bank can give you, or we're also limited with the servicing with that bank alone. So if you're planning to purchase more investment properties, I think it's best that the variable rate is probably, because the easy to get out with no penalty, and you have the capacity to go anywhere else, right? You have that flexibility. I mean, you can be, if servicing is an issue, then we go to second tier.
And the other thing is about if you're going to sell the property, right? If you fix your interest rates for 3 years, 5 years, you'll be paying a break fee, and sometimes those break fees can be very, expensive. So this is the exciting part. I think a lot of people have got lots of questions about interest rate forecast, and I'm going to jump into this. I'm going to give you guys all a big, massive disclaimer. Always say, do your own research. Don't trust me. I'm just some idiot on the internet giving you some feedback. I'm not always right. I'm making my own bets. I'm making my own decisions. I'm doing my own research. A lot of people didn't trust what was on the news last year in the media, and suddenly they're asking questions. Oh, is Ukraine going to win, or is it going to be Putin, or is it going to be ScoMo or Albert Sleazy, or whatever the case may be, Scamo or Sleazy, right?
It's not easy without an easy, is it right?
Whatever it is, right? I couldn't care. None of it's right. It's all, they're all actors. The whole thing is a circus. So I do my research based on facts and figures and history and prognostication. I'm trying to calculate out and reverse engineer what a solution could be. And you asked me beforehand, Rose, do I think that surely you couldn't go up over 2 years by 25 basis increases? Firstly, the interest rates going up at the moment. Someone just asked, who am I voting for in the election? People say you shouldn't talk about money, religion, politics, or anything like that over the dinner table. I'll talk about it all. I used to be a very liberal guy. I think I'm politically atheist because they're so much alike. If you had 2 puppets, one on each hand, right? I want to know who the puppet master is, right? Whoever creates the money is the controller. So whoever's presented to me, it's a selection. It's not an election. I can't choose. I don't have a choice. I have a selection of 2 people, 2 options. That's all you have. So I'm not really excited on that front. And I actually just want to before I go into this, Josh asked an interesting question, and it's very easy for me to answer this one. Would it be better to fix for just 1 year rather than 3 years? No.
Well, what is the point?
So if you're fixing it for 1 year, you might save a couple of bucks, but the interest rate's already so far higher, right? But if you want to refinance, which I know you do, your equity will be stuck in there. Secondly, when you go after that 1 year, you're going to lose all your discounts, which is going to be the 2%. You'll be paying an extra 2%. If you lose your discounted interest rate, you will literally be paying an extra 2% for the life of your loan. You're going to screw yourself up. So think very, very careful before you go to that fixed interest rate. Whoever is watching and thinking about it, do look at all the terms and conditions, and do think about what will happen to your loan after that fixed rate period. Okay, this is where I pull out some charts and I share with you guys some interesting commentary. this here is a yield curve, right? And this is bonds, right? So when you look at bonds and you look at like interest rates in different countries, whether it be, if we've got here the United States yield curve, and I refer a lot of things back to the United States, and it's not because the United States is something to follow, it is that all currency is based in US dollars. So currency is created and spent via US dollars. So if you follow this chart, you'll see three lines that go across. One is orange, one is greeny or gray. I can't even see it on my screen.
Green.
It's green like Zinger, and the other one's obviously blue.
Yeah,
is it pink? It's blue. PI is purple.
Oh, that's right.
Yeah. Colorblind, maybe. Women can't be colorblind. Did you know that?
Well, I am.
Are you?
No.
No.
I just don't realize the PIA is.
Yeah. No, it's actually a thing. It's something that's real. So anyway, going into these charts. So this chart, if we go down the bottom and look at the index here, the blue is current as of today. The green one is as of 1 month ago, and the orange one is 6 months ago. So if we look at the upside on the side, the index here is the percentage points of what is the return on the bond. And if we have a look at the bottom line, it is how the tenure of the bond. So a 10-year bond, for example, is somewhere here. That is the rate. So if you're getting a 10-year bond, the US is based in at 3% at the moment. A month ago, it was, where is it here, about 2.5%. And 6 months ago, it was based on about 1.5%. So it's shot up about 1.5% and doubled over a period of 3 months. So when we look at that, that's just showing where it's changed over the last 3 months for each of these. If you've got a 30-year bond, or if you've got a 2-year bond or a 3-month bond. So this is very, very important to look at. It's boring as fuck, but it does have science here. This here is a positive yield curve. So if you put your money away for 2 years, you're going to get 0.5%. You put it away for 5 years, you're going to get 1.25%. You put it away for 10 years, you're going to get 1.5. So the longer you put the interest or your money away, the bigger the return that you're going to get. So then we look at now, if you put your money away for say 2 years, you're getting 2.6 there. And if you put it away for 10 years, you're only getting 2.35. So you'd be better putting it away for 2 years than you would be for putting it away for that. And then if we look at it now, it's flattening. So something that's gone here is a positive yield curve, a negative yield curve. If this was in the total opposite direction, it would be a negative yield curve. We've got here a flattening of a yield curve. What happens is when the markets implode, right, and the bond markets implode, it means that the risk is taken away and people are wanting to put their money away for a shorter period of time and not for 10, 20, 30 years. What happens is when you're getting the greater yields over here, that means that all the liquidity is flowing out of the markets from the longer terms into the shorter terms, right? And what it causes is a liquidity crisis, which is a deflationary event and a recession. Right, a recession and depression. So if the yield curve is positive, it is a good economy. If it is flattening, it is going into recession. If it is negative, every time interest rate, the bonds have gone negative, we've seen a recession. So I want to go on to a few more charts. So that's just some basics of it, right? And I encourage everyone to keep an eye on the US yield curve and the Australian bond yield curve. It is changing in Australia at the moment. So just having a look here, if we look at the bond yield here, we can see it is flattening, and it is, if we have a look at this one, it is inverting. So you can see the green one is going up on the short term. This is very clear with the one from only a week. This is a week change. The shorter term is going up and the longer term is coming down, which is a flattening. And then once it flattens, it only needs to flatten a little bit, and that to me is code red. We've got a massive fucking crash coming, right? We've got a recession, stock market's going to turn to shit, everything like that. So then we can see that that's clearly flattening out, and when it goes negative, we have a big problem. So if you note that as these things are occurring, right, if we go back to this chart here, we had a positive yield 6 months ago. Where would that have taken us? That would have taken us to October last year, sort of period, November. And then we've got, you know, April, March, April, then we've got May. Now, what has happened is that stock markets have crashed in this period. We've got crypto markets have crashed. Every market is crashing, right? That will cause a recession, massive recession. And this is what happened back. Here's another chart, right? This is what has happened, and I will explain these charts, right? These are very important things. So take screenshots of these, take photos of them, and just reflect on this in the future, right? Because what I'm saying, I'm happy to put all my credibility on the line, and you know, people might think I'm a dickhead today, right? But in the future, they'll be like, fuck, how did Birchie predict that? Is he a time traveler? No, he's prognosticating and looking into the future and reverse engineering what is in front of him. So if we have a look here, this is a very important chart to look at, right? So this one here on the left is the yield curve currently. So this blue line is the current. This lighter grey one is May 2020, and then May 21 is the darker grey. So if we look at this looked like a fairly attractive yield curve. This here looked like a much better yield curve. So this, what happened, right? We had Corona, we had certain things, the market was shit. What did they do? They fixed the yield curve, right? They printed lots of money, they made the interest rates cheap, and they survived the market. So the markets responded with a positive yield curve. But when they stopped with the inflation, when they stopped with the currency creation, once they started changing the cost of the money, what has happened is that the yield curve has crumpled up and turned into a negative yield. So here we are currently, and if you had a bond for 3 years, which is paying 3%, or you're getting 10 years for 3%, it's going negative. So it is going to turn very, very bad. Let's have a look at this historical 10-year to 1 year inversion of the spread, which is the 1 year, which is about here, which we're heading up to there. This is 0, right? This is your baseline here. The inverted yield curves predict the last 7 recessions, right? 1970s. These grey lines are the recessions, right? I find it funny, right? In Australia, someone asked me who I'm going to vote for. Everyone hates Paul Keating, right? The recession we had to have, the words that came out of his mouth, right? I was 7 years old then. I knew nothing, right? I got no idea, no memory. I could just see old archive videos of this guy. Everyone says he was a prick, right? What he said was probably harsh and was probably true. It may have been an honest politician, right? He may have been. Because if we look at these are not Australian charts, these are global charts. This here is a recession in 1992. It is the same recession that occurred in every country around the world at the time. Our markets are global, they're tied to a US dollar. The amount of liquidity sloshing around the system is determined on whether things are going up or going down. If we have a look here, the grey parts of the recession, and just prior to the recession, each recession, it went under and they inverted. The yield curves inverted. The bigger the inversion, the bigger the recession. The longer the recession went on and the deeper the recession went to. So if we have a look at this, we have an inverted yield curve, and then we were followed by a recession. We had an inverted yield curve, followed by a recession. We had the GFC, it inverted in 2007, 2006, and then we had a recession in 2008 and 2009, and then we fixed it by dropping interest rates. We dropped interest rates, yields didn't invert, right?
Start of a low interest rate in 2010.
Correct. But each time, think about and overlap the RBA rates, right? What happened with the RBA rates? Then we go to October 2018. We started to see the market go sideways. And I've got the next chart to show, which will look more exciting. And then in September 2019, I did a Facebook Live, and I did a few master classes, as I'm going to start calling these things. And people like, Birch, you're off your head. I warned about in 2017, I called it the global financial depression. And some people used to comment on my videos saying, Nathan, get off the drugs, stop snorting cocaine and all these sorts of things. I've never touched it. Imagine if I had a bag of Coke. I'd be like talking. I'd be brilliant. I've never tried it. I'm too scared of it, right? Give me dead, I'm fine. But it was funny because people were hanging shit on me for the things that I was saying. Anyway, we saw it invert, and then we saw the biggest money print. Why did the yield curve not invert? Because we printed money and we made it very fucking cheap. What happened in the middle of 2021? We went from quantitative easing to quantitative tightening. We had a blunder in around March last year, May last year. What happened to Bitcoin? Bitcoin and all the cryptos crashed, right? We then printed more money. We locked everyone in their home, forced them to go and have an injection, and all those things that had occurred. And then suddenly the market started to take off. We introduced more JobKeeper, more stimulus packages. And then suddenly the market went up a little bit. And then we stopped it. And now it is falling off a cliff, right? As we can see here, as we're going into quantitative tightening and removal of all the stimulus packages, our economy is stuck on a cheap credit. It is like an addict, and it needs more and more to take from, it needs more food, basically. Here we go looking at the US 10-year. This is like probably the best one for you to go and look at. The US Treasury 10-year minus the 2-year spreadsheet. So this is the inversion of the 10-year over the 2-year. We saw the inversion, so we've got this line here, which is the 0 basis point, the 0 bound, and then we have over the top, this is -1, -2%. This is 1%, and this is the difference. That's the spread between, if you locked your money away for 1 year or locked away for 10 years, that's the difference between it, or 2 years versus 10 years. So in each of these times, it inverted, we had a recession. Inverted, we had a recession. This proceeds by about 18 months. But the rapid rate that we are forced to do this right now, because we're at a 0 interest rate policy, there is nowhere to go. This will cause either massive hyperinflation from them printing too much, or it will cause massive deflation. So looking here at the GFC, we can see it inverted slightly, bang. We captured it well here, right? We had it in September 2019, and then we had a recession in the start of 2020. They blamed it on the alleged flu illness out there people had, right? I'm thinking of my words carefully because I'm going to be cutting this little part out and putting it onto YouTube tomorrow. But then we had this recession here that was a blip. But if that didn't get fixed up, we would end into a massive depression, which is why I said would end up in the global financial depression. Looking at the next step here where we're at, we're almost at the next inversion, right? And they're trying to stop it, but they can't. They cannot stop this. They cannot control it. So as they push up these rates, this is going to invert massively because there's too much risk. So as they push interest rates up, we're going to see, look at what happened here. We've got the biggest recession ever. We've got the biggest recession ever. They either have to bring it down, or we're going to have the biggest crash in the world, right? Ever. Bigger than 1929 stock market, bigger than anything. So the question is are they going to let it blow up, or are they going to print more money? And if it blows up, the handlers of the politicians, the handlers of all these people that are in charge, the puppets is what I'm talking about, the avatars that are in the media, they're the handlers, they blow up as well. So they need this system to keep alive until they can fraudulently take everyone from this system over into a new system. And that is where we're at. And that's what this decade's all about. We're going to see the whole currency system crash and massive inflation. The only way through this is inflation. Inflate your way through, because the debt becomes irrelevant with inflation. And that's where I'm at, and that's where I'm putting my money in. That's what I'm banking on. Look at this chart here is the US 10-year over the 2-year. Once again, we can go back to 2017, and I've got this chart because I want to expand and spread this out further. So if we look in 2017, when I called that we're going to have the big global financial depression, the inversion got down to around here, right? And I said in October 2018, it was the 10th of October, it was between August and November 2018, I said we were going to enter the depression. And what happened is we came so far close here, and then the market got rigged, and everybody's crypto fell, everyone's shares fell, everything turned to shit. What was happening is they were taking $50 billion per month worth of money that they'd printed out of circulation in that period of time, and they were trying to jack up interest rates. What happened, if you have a look here, this is going down and it's getting closer, or this is going up or up and down or whatever. But if you look at the period from the start at the end of 2018 to the September or so, the middle of 2000 and no, sorry, this is the middle. This is when they started dropping interest rates in Australia. This is US, by the way. This is when they started dropping interest rates on the 4th of June, 2019. We saw our first interest rate cut, and that's around this period of time. So what happened is the market shit itself here, and people were like, Birchie, how did you predict an interest rate cut on that day? How did you predict that things were going to happen? And that was by looking at all this information. And as we proceed from the middle of 2019, for the following months up until September 2019, the repo market exploded. So what the repo market is the repurchase agreement. So every day when the banks close, you have interbank settlements between the banks. So you have, you know, CBA owes Westpac $1 trillion and Westpac owes NAB $1 billion, whatever the case may be. The money that's circulating in the back of these banks, and these are like US banks, what happened is that one of them or multiples of them were insolvent and there wasn't enough capital. So the repurchasing agreement came out, and the New York Fed started purchasing hundreds of billions of dollars worth of bonds every day, which were 3-month bonds. And the 3-month bond sucked all the liquidity out of the market. So the yield curve went whoop and flipped over really badly. And then suddenly we've got a virus, and we've got lockdown economies, we've frozen all our financial markets, and we saw money printing like never before, and we got out of it. And as we went through, we had a recession here for a period of a couple of months, and then we saw the highs, the separation of the yield curve, and it went back to a positive format. But once they stopped around here, once they stopped the production of fiat cash, like really cash trash sort of money, we saw the market starting to fall again. And we can see here when we spread it out and look at it on a very you know, smaller level, we can see that we had a little dip here, which is what caused the alleged recession that we were meant to have in 2020, which was printed over. And we've just had another one a couple of months ago. This here was caused because they tried to put the interest rates up. This is because they wanted to try and remove the stimulus packages. And I'm betting you that each time one of these packages ended or disappeared is when the markets closed down and went to invert, because there's too much risk in the market. They're going to try and artificially do this, but you cannot maintain a healthy yield on the bond market if you are doing what they're doing at the moment. And for me, that is saying one of two things. They can try and you know, increase these rates as much as they want. I believe that we have a window of less than 24 months. I put all my reputation on the line by saying these things. Within the next 24 months, we will see the interest rates come down. They can put them up as high as they want, but the higher that they put the interest rate up, the bigger the problem that they're going to cause. So they're going to have a problem like this. Are they going to have a problem like this? They're going to have a problem like this. And what is the percentage that we are going to have to see them reduce it? Technically, looking at all the information, interest rate should be 3% right now. If they go to 3%, everybody dies. And just following on with a little bit of repetition from last night's Facebook Live, what will happen is a lot of people think, Rose, I'm going to ask you the question here, just for your feedback consultation. I've never asked too many people, but I'm only surmising here. Out of the world, we have lots of money that's printed out, their debt, right? We have everybody that's watching this is worried about their debt on their home, right? That's most likely where everyone's watching this. But if we look at the rest of the debt in the world, where is the debt gone? The debt is governments. The debt is big institutions. It is Coles, Woolworths, the trucking companies, the petrol companies, all the large corporations have debt, all the large institutions, all the governments have debt. Australia is now into, when Paul Keating was in 1992, in that recession that he had to have, he raised $96 billion worth of debt. In the last year, 2 years, we have seen $1 trillion worth of debt. So 10 times more debt in the last year than back in the Keating era. What level of debt, what price did the government get the debt at? Their bonds were at 0.5%, 0.25%, right? If the rates go up to 2%, 3%, that means that the government's debt has now gone up 5 times. So if you think you're going to die with your mortgage, the government's going to blow up, right? What percentage would, let's say all the debt out there, would it be, say, 50% debt towards homeowners and 50% towards business, governments and all other, or would it be 80% to business other and 20% to property? Would it be 100% to property and no debt, no business has debt? What would be your thoughts of the percentage difference? Do you think?
I think the mortgages, like property debts, is probably just in comparison to business debts, right? It's
Yeah.
probably just, I would envisage around probably 35%.
That's what I guessed out of the top of my head, right? And that's what I'm working on, right? 30% debt is based on mortgages and 70% as business. I just pulled that number out of my head. But let's assume it's 50-50, whatever it is, right? So everybody's mortgages, you've just been talking to everyone this evening about the interest rates at 5%, 4%, 3%, 2%, right? Now, let's go back to those businesses, right? How do they buy their debt? Do they pay 5% for their debt? Or do they do a BBSW with a bank bill swap rate?
I think it's a swap rate, isn't it?
They work on a swap rate.
Yeah.
So go and do some research on a swap rate and what a swap rate really is. What a bank bill swap rate is basically if the RBA is charging 10 basis points, the bank will add a 1% premium to that. So it's 1.1%, right? If the RBA is charging 1% and the bank charges a 1% premium, then that is now 2% interest rate, right? If a business's debt is costing them 10% of their revenue or their profit, imagine if that doubles next year, right? The cost of a business debt and commercial debt, because it's worked on a bank bill swap rate, will double, quadruple overnight. So last night, or the night before, businesses were going to bed and they were paying 1% premium and a 10 basis points, so they're paying 1.1. Now they're paying 1.35%, right? So their rate has gone up 30% overnight, their cost of debt. So if the market's going to shit itself, it ain't going to be everyone watching this, it's going to be in trouble. They might get into trouble, and the most reason why they will get into trouble is because they probably won't have a job, because their business that they're working for, which has debt, is going to go and implode. So then they're going to have to now bail out the businesses, right? There's going to be a whole pile of new stimulus packages. There's going to be a whole pile of reducing of cash rates around the world. So this bond market is dead. We cannot get off zero interest rate policy. My prediction of it is that we could see, I always thought 2 25 basis point increases, my personal thoughts, and hold me to it as much as you want. I ain't going to stick because I'm just talking shit right now, right? Who knows what's going to happen in interest rates? I don't have control of that. You guys don't have control of it. We're not the controllers of this money and currency creation out there. It is our keepers that are doing that. So when we look at, the central banks around the world controlling the cost of the rates, if they go up 0.5%, my calculation tells me that that's the point where everyone starts getting the shit. If it goes up to 1%, we're going to see a bigger recession and we're going to see a bigger problem out there. If it goes up to 2%, and just remembering, interest rates were 1.5% for 6 years, right? 6 years,
Since
less than that.
No,
Since about 2016 or so, 2017, interest rates have been 1.5% or less. And they've dropped for the last 2 years, 3 years, 3 years it's been now. The interest rates have dropped to less than 1.5 because they fell down in 4th of June. So if the interest rates went up to higher than what they were 6 years ago, and if we pulled out a chart that showed what yields look like, they never go back to the old all-time highs. But if it does go up, however high it goes up, it's going to have to come down far greater because there's going to be such blood on the street, and they're going to have to turn the course of action around very, very quickly. So my prediction is that it will not last more than 24 months, and I think we'll probably tap out over about 3 months or 4 months, and we're going to start seeing big recessions around the world. We're starting to see in other countries, we're seeing the yield curves inverted, we're seeing a lot of things that are going pear-shaped. You can sit there and get an education lesson from watching the news, which are just a whole pile of fucking puppets that are placed there. I always question, who are these people? I've been in the media, been on TV over 100 times. I see the things I can say. I could never say anything like this on TV because I'll get shut down, and it's against the advertiser's position on there. I share this information because I hope and I know that in periods like this, I'll do very well out of it, and people will be like, oh, wow, Nathan, thanks a lot for your advice. And that's where I do well and I shine. I don't need to go and be a product and be put on TV. And I see all these avatars that are out there, and they're puppets, right? And you can say this, you can say that. They've got little things that they can read and scripts and dialogues. And I just say things as they are. And I try and deliver you guys as much sort of content and insight and things that are really controlling this. It's not just because people are like, oh, wow, we've got some inflation, and they create division around it. It's like, you fucking idiots, right? Like fucking idiots that are putting this dribble out of their mouth, creating division, creating, scarcity and fear mongering, whatever. If you couldn't afford your property 2 years ago at 1.5% interest rate, and it's currently at 35 basis points, well, then you probably didn't have the right strategy to start off with, and you haven't protected yourself from a cash flow, and you're a time bomb. There will be lots of people that will blow up, and it will be those people that are our saving grace, because those people will explode, and they'll be like, oh, wow, we need to help these people, right? And when we come along and help those people, all of us that have protected ourselves well, had a good sound strategy, had good debt, had a position of, making our calculated decisions, we will get really protected with all the benefits that come to all those people that were idiots in this party. So on that note, that's just my 2 cents. I think interest rates should go up maybe about 0.5% and then come back down. They could go up to 1%. Any higher that they go between 0.5% and 1%, we're going to see so much fun on the other side of this. It might be pain for 12 months, might be pain for 24 months. I'm hoping that my jovial excitement about this isn't pissing people off, because people are like, oh, my interest rate's gone up, it's hurt me, and all that sort of stuff. You need help, reach out to us, we're here to help. But as an investor, you're not speculating, right? You shouldn't be looking at 2 months or 6 months or 12 months or 2 years. You need to be looking at your big term goal and your overall picture of what your strategy is, where you are today, where you're trying to head to in the future. All of these things are expected. There's always a gatekeeper to help you, to stop you from trying to get to the next level. Most people get their ball, get the shits, pack up and go home because they're scared, they're upset. And I love that, right? Weak hands, give me your weak hands, right? Weak hands lose assets, strong hands hold assets, strong hands gain assets. You've got to make a decision. Where are you? Do you have weak hands? Do you have strong hands? Go follow the crowd, or go make educated decisions, research yourself, arm yourself with knowledge, and make those decisions. Yeah, with that, seen there's a lot of questions here, and I will answer the last few of those questions. I've had a bit of a rant here. Thanks a lot for being here and watching me have this, and we'll get on some of the questions. And also, I was thinking beforehand, there was something I wanted to say. When you said, Rose, that that you have been a broker since 2002, right?
Yes.
You've been a broker since 2002. You've seen lots of things over the years. You've seen lots of different market cycles. One of the things that I think everyone should be knowledgeable about you, Rose, is that recently you became a platinum broker, right? There's only, how many platinum brokers are there?
17 nationally.
17 platinum brokers. 70 brokers, platinum brokers for CBA. Rose
nationally
is one of them. So nationally, so Rose is 1 out of 70 of the top brokers in this country who can help you with the products. What are the benefits of dealing with a platinum broker rather than a non-platinum broker, one of those peasant brokers, Rose?
I think being a platinum broker, less assured, you're in a good hands, right? I mean, the bank recognized my capabilities, the quality of my submission, the knowledge that I have within the CBA products, and the volume of loans that I make that I write every month.
Yep.
One of the benefits is that I have a dedicated person when I run the scenario. If I come across deals that are curly or curveball, I can run it with them and say, this is the scenario. They get back to me. There is a reference number, and I can launch that application with that reference number because it was already cited by the credit manager or some sort.
Okay.
And obviously the turnaround for me is when I launch application with CBA, sometimes 2 days I get approval. Yeah, so Yeah. So it is a very privilege to be recognized with CBA. I mean, there's only 70 of us, I was told.
High five, Rose. There we go. Good work, Rose.
Yeah.
And I can see there's some questions coming through. We're now at that point of the night. Ask some questions through, and also if you want to get in contact with Rose, you can reach out to the team. It doesn't have the Zinger details. You can contact Rose directly at rose@zingerfinance.com.au. But as always, easiest just to speak to the investor relation team member from my team. They'll get the information and then pass you on to Rose and her team, and then she'll have a greater understanding on how she can help you, and better use of your time when you're with Rose, rather than her trying to get some information and try and work her way out. So on that note, let's look at some of the questions. I love it when Birchie starts talking about yield curves. You get super excited. The mullet just adds special effect. Thank you. It's more of a rat's tail. I don't even know what it is. I've been growing it for some while now, and I think it's time that it should go, probably. I didn't think I'd grow one, and I probably will never grow one again, but I just sort of keep at it. You stay committed with your goals. So Birch, the computer is glitchy. Not too sure what's going on there. I've got our good quality mics. A lot of people always say, oh, you need good quality mics and stuff. I actually have really expensive mics here. So 100% agree with you, Anthony. Thank you. Robbie asked property price prediction for the next 12 months. If you ask my thoughts, I think there will be some bargains out there. I think people will start getting scared and there'll be glitches. Like if we look back in the start of 2020, just remembering interest rates were about 1% then, or about 75 basis points, somewhere around there. I'm sure someone will correct me on that. But interest rates were much higher. There was fearful of impending doom. Every media outlet was saying the property market was going to drop 20 to 40% in the start of 2020. What happened is we saw one of the biggest booms ever. I think people that are in lots of trouble, that are over leveraged, too under leveraged, too over leveraged, and they'll be in massive trouble. There could be some good opportunities out there. Do I think the sky is going to fall in? No. I think some markets will actually go up, and there is a lot of opportunity out there. So make educated decisions. If you've got access to finance, go and take advantage of the market, because when we see hyperinflation, when we see the rates come back down, and we see stimulus packages for them to fix up the mess they're about to create, we'll see the largest boom we've ever seen. New Zealand reserve rate up 1.5%. 4 rate rises. The last one was 0.5. Good point there. The higher they raise these rates, the more the mess that's going to happen, and the more they're going to have to bring them down. It is very possible for them to put them up 1%, 1.5%, 2%, but that is very temporary. The damage that will be caused from this cash rate, this change in monetary policy, they call it a change in monetary policy. The impact of this is going to be so devastating to a lot of people, specifically GDP, and we're going to see inflation, but we're going to see productivity go down and all these sorts of things. So we're going to see massive issues out there, right? Massive issues, like depression sort of stage. But we will see what comes from the other side of it. I'm very confident on the interest rates coming down on the other side of this. So if they go up to 5%, right, the chance of going to 5%, everybody's dead, right? And I'm talking RBA level. I'm not talking about what your interest rate is. If interest rates went up to 5%, everyone would be dead, and we wouldn't have an economy. They've tried to starve off recessions by printing so much money, making it so cheap and affordable. They need to keep this as an inflationary economy, because the dollar dies. If we have a deflationary economy, the currency dies, and we have the crash of the Western world of what we know it. So well done, Rose, on platinum status. Totally well deserved from Danielle. She sends her regards.
Thank you.
George said, but isn't the agenda to crash the economies, to bring in the new digital economy? So understanding the previous history of yield curves and what you predict to happen, elites will not let it crash. So everything is destroy is fucked, is his point, to install the new agenda plan. Yes, exactly. I do believe that on the other side of this, as we see hyperinflation, if you were the gatekeeper, you would want to try and take as much pieces off the chessboard as possible. The way to do that is to starve and impoverish people, which is to take their ability to afford things. So then you are the one with more money. However, hyperinflation does that. So when people, some people might be watching this and are familiar with things like World Economic Forum, the commentary coming out there, you'll own nothing, be happy. Having the own nothing, be happy doesn't mean people are going to get confiscated. Someone's ultimately going to own it, but owning, not being able to afford it and being happy about that, that's the world we're living in. People don't even own their cars nowadays. I reckon 80% of the cars on the road have a loan attached to them. So the car is a financial instrument nowadays. It's not a car for driving around. It's someone's asset, which is a loan product. The car, who cares about the car? It's just someone stupid enough to go and get the loan and, them sell it that product, right? I've had car loans before, and I'm saying it in tongue in cheek. But people don't own their car anymore, so that's okay. So when you own nothing, because everything's attached to debt and you own access to debt, and a world that's based on a global credit score and open banking, which got introduced in 2016, we're starting to see the picture of, being tied to that system and dependent on the system. The system doesn't like other people owning assets like properties and property rights and common law, because that takes away their ability to control you, and it gives power back in your hands. I'm a sovereign citizen. I like to take control of my own life. The slogan for the business for a very long time has been live life on your terms. You can see it in all of my material that I put out there. Everybody should have their own personal liberty and freedom. Property gives you the ability to do that. So does a lot of other things in the world. I try to keep it mainly towards property, because that's the pathway out, the vehicle to get us to where we want to be in life. Love talking, these things. Yvette, thanks so much for today's session. It was by far one of the best webinars ever, in capitals with exclamation marks. Timing is everything. I can't wait to re-listen to this again. I've got so much out of it. Awesome. Thanks, Yvette, and appreciate the feedback. Rose, as always, Rose is always nervous. She's like, "Oh, Nathan, you're a pro at this," and people want to hear what you have to say. People love what you have to say, and you've got all the knowledge there. I don't have this knowledge. You're the one with the knowledge. I've got my own knowledge. You've got your own knowledge. Mahesh said, in case interest rate is happening globally today in India, RBI has a home loan interest rate increase. Home loan is going. I'm only reading the hyperlink here.
So many
RPI hikes, repo rate loan. I'm reading the little bits there. So it appears that the Indian central bank has increased the interest rates. This is a global thing, right? They're taking away all the money they just created, and yeah. Andrea, love your rant. Always trust you in prediction. Well done, Rose, on platinum status. Everyone's saying well done, Rose. Justin, great webinar again, Nathan and Rose. Justin, you're the one that made me think about a bit of a conversation that we had the other week, which is interesting, because probably I reckon it could be 80% of the debt is created on commercial debt terms. So yeah. Robbie said, what is your prediction about tightening lending criteria? They're tightening lending criteria by pushing up your interest rates. So if you're thinking of servicing, you're thinking of changing your rates, if interest rates go up, does it become harder to service?
Of course, it will be difficult to service, but there's a way.
So if interest rates went up 2% today, and the average punter that's got a $2 million property that they just bought and they can't afford it.
But you have to also remember, wages should increase, right?
They should.
I mean, what's the CPI? What's the
It's a CPI. It's a CPI. They're lying about the CPI.
But right? At least, yeah. So.
But my point in general is that, like, say the top end, like the stuff that we play with, like the properties that we're looking at, is relatively low risk, right?
Yeah.
You've got the people going out spending, they're on 100 grand income, they're trying to buy a house worth 1.5. The house has no eaves, has no backyard. They have a nice park down the road because everyone's got no yard, and they've got to all put their kids in a community park. And those people are going to be in very much trouble, because then if the interest rates go up so high, the next person going to buy that asset won't be able to service for that. But the lower end fruit, everybody can service for the cheaper end properties.
Yeah.
So there's a pent up demand of people for the more cheaper properties. It could put a floor in the bottom end of the market and drag down the top end of the market. So there will be split markets here when these sort of things happen. you know, markets do, you know, shift off, as we can see with the separation of the yield curve. We will see some markets come down, some markets go up, and it's important to understand and sort of have a finger on the pulse as to what could happen on that next step. So, yeah. Looks like we've answered lots of questions here, and we want to keep it at 2 hours. Rose said, please make sure that you don't go over 2 hours. And I'm looking at the time here. I want to thank everyone for spending 2 hours of their time with us on a Wednesday evening and listening to what we have to say.
Thank you. And please call us or email me at rose@zingafinance.com.au.
rose@zingafinance.com.au. And as I said, Rose has been my personal broker for almost 20 years, probably 18 years, something like that. And you know, I wouldn't have my portfolio if it wasn't for your expertise. I probably caused you lots of stress over the time. I probably caused you stress every day of the week. So thank you, Rose, for dealing with that. And it's been a fun journey. And thanks a lot for being here tonight, Rose. And
thank you.
We will catch up soon. Have a great evening.
Thank you, guys.
Keep being awesome.
Good night.
And make sure the decisions you make today are the ones that are going to really affect you in 5 years, 10 years, 15, 20 years time. So yeah, be wisely with them, and we'll catch up soon, guys. Bye for now.
Bye.
Well, where's my hand off the screen? Cheers.